Okay, hi team. On Tuesdays we broadcast our team trading room via YouTube live streaming. So welcome to our guests that are listening in. This is Vance Williams out of Seattle area. That's in the United States. For those of you who don't know me, I've been trading Forex and training people for about 10 years now. And I can guarantee if you watch me for a while, you'll understand a lot more about how this really works. And everything I do is in real time. So if whatever I talk about, I'm talking about it before it happens, and that's the way we pretty much do everything around here. To our team members that are listening in our private area, you guys, if you have a question, be sure and just jot that down for me. Now, this morning I'm going to show you how I, 1 second, let me see. Yeah, we're good. This morning I'll show you how I evaluate trading setups. Always keep in mind that what I'm telling you or what I'm sharing has to always lead to a trading setup. I'm not just going to talk about gibberish. I'm not an analyst. I'm a Forex trader. So what I post in the mornings is about real trading potential, either potential or the lack of it. And it's very important that you're applying complete logic. In other words, if you make a decision, it's critical that you're covering all your bases, and there are specific elements that affect your probability of winning in every trade. So we're going to look for two things as traders. Number one, a high probability advantage for buyers or sellers, and two, a range big enough to enter and exit with good risk management. And we're always doing just those two things. Okay, so the first step is always market conditions. Market conditions are one of the 5 core elements that affect your probability of winning any trade. It's really simple. Basically, what we're looking for is, are there any events that are pending that could affect price movement? Are the markets open? Right? If it's 4 o'clock in the afternoon on the East Coast or 5 o'clock, the euro market's closed, the pound market is closed, and the United States market is closed. And so, if you're trading the euro dollar and the pound dollar, it's probably not a great time to trade, right? And yes, they are moving very often, but someone else is trading it, right? And the volume is going to tend to be the greatest and the most consistent when the market is open. The other thing we're looking for is it business as usual? On the extreme side, we saw a lot of panic over the last 4 years. Is Greece going to default? Is the euro going away? There was just a lot of things that kept everybody kind of on the edge of their chair after the big financial crash. The markets have been pretty stable since last January. But prior to that, you could have showed up on any given day and they could have been panicking. But when traders do see something that causes concern, traders and investors, they're going to move money differently. They're going to take additional steps to manage risk if they see some potential problems. And so that's why market conditions have to factor into what you're doing today. No high impact data left out this morning. Business as usual on Wall Street. This is ideal conditions for trading, right? But if any of those conditions were off, regardless of what anybody tells you, your probabilities of winning have just changed. And so you just have to know that it's not complicated. You don't have to understand, what the central bank's going to do or what it means if the rate decision changes in England. You don't have to know what China's doing over in Australia. You just don't have to know any of that. What you have to know is what's going to affect your probability of winning. So, I always like to kind of sum that up with this. Your ability to anticipate what's going to happen in the market depends upon what is usual, not what's unusual. So you can anticipate the future because of repetitive human behavior. So if something unusual is happening, just think higher risk. If everything is business as usual, then think lower risk. So no matter what we're looking at when it comes to market conditions, that's what we want to know. Is this usual or unusual? Usual is good. Unusual we want to avoid. Um, and if you just want a simple real life example, I mean, what you're doing is you're anticipating, predicting price movement. You're predicting what's going to happen. So just imagine your best friend and imagine you guys going out somewhere and something happening. You will be able to predict your friend's behavior because of what you know your friend does all the time. If he drinks a lot and drinks to excess, you know if you go to the bar, he's going to get drunk and obnoxious. How do you know that? Because that's what he always does, right? Okay, so we're doing the same thing here. You just have to learn the behavior. Not chart patterns, not candle patterns, but behavior. Okay, so as I said, market conditions are good this morning. Let's go ahead and take a look at the charts here. You probably can see my mouse moving around here. When I arrived at, I'm going to talk a little bit about what happened yesterday. I'm going to talk about the most repeated pattern in forex trading briefly this morning, and I'm going to show you what happened yesterday and just show you how that really unfolds in real life. But first, I want to tell you a little bit about what I saw when I showed up this morning. First thing I saw is I saw price moving up off the bottom here. Pretty strong move. You generally got to kind of feel for the range, but I like to use the crosshairs, and I can see it move 65 pips up off the bottom. You can see exhaustion here. In other words, it pushed again, it pushed again. It's exhausted. What exhaustion really means is it can mean a couple things. Number one, that the people who move the market are out of money. It's kind of like if you go to the fair and you have $75 to spend, and we see you carrying 4 or 5 stuffed animals and eating a corn dog, we can pretty much know that you're probably running out of money, right? And so by knowing the average movement that the market makes, you can kind of get an idea of when they're exhausted in terms of the money. But in terms of watching a pattern, whenever you see a strong move and it does a good pullback and then a second push, the psychology is exhausted. In other words, what causes traders to move in a particular direction has already played out. And we'll talk about that coming up too. So I saw exhaustion here. I saw 65 pip move up. See the money's turned over. The 21 and 55 measure the turnover points of the intraday movement. That's intraday is usually referred to as something that happens during the day. I refer to kind of an intraday sentiment that can actually have a trend that moves over 1 day, 2 days, 3 days. Anyway, when I say intraday, that's what I'm talking about. I'm talking about what moves the market 1 to 3 or 4 days. Okay, so what I saw here is that price had moved up, and it still had room to move to this area right here, which I consider probably the next area where you're going to run into a lot of sell orders. So the idea would be here is if you can recognize that area, you have a strong move up, and if you get a big enough stretch out here in a pullback, you still got room to move to 13600 or 135999 that I've got here. So there's a potential trade there. I did take a look. I dropped down to the 5-minute to kind of zoom in and get a closer look at that. And what I saw was the move was only about 17 pips. That's not big enough, a big enough wave to enter and exit with good risk management. So just kind of figured there's nothing here this morning. The pound over here on the other side, you see the U.S. dollars moving up the chart, not up in value. Up in value would be going down. But the U.S. dollar is also moving up the chart here on the pound. And so we look at the movement, about 80 pips up. That's pretty good. It's pretty typical for the pound to move a little bit more than the euro. But unlike the euro, the pound had hit the top of its clear range. I mean, this is easy to see. And so, as you see, it's coming down here. The probability that it's going to keep on going, no matter what you see right here, is less because it's running into here. This is going to attract sellers. So in order for since our trend is up for the day, and for us to consider a trade, price is going to have to get above here, right? And again, we're not talking about the probability of something happening. We're talking about the high probability of something happening. And, this is something that most Forex traders do not know. Unless you're winning 70% or more of your trades, when the market behavior changes and you suffer a number of losses in a row, you're going to be psychologically disabled if you are winning less than 70% of your trades. And the reason why 70% is important is because there's a direct correlation between your winning percentage and the number of drawdowns that will that have the potential to occur when some market behavior does change. So it's very important, especially with me working with traders that have less than 3 or 4 years experience, maybe only 3 or 4 months of experience. It's very important that you're focused on something that keeps that winning percentage above 70%. Otherwise, you just basically, you'll trade a method, and as soon as you lose 3 or 4, it'll be so painful, you'll go, geez, that doesn't work, and you'll try something else. And you'll likely be like many traders and repeat that for 3 or 4 or 5 or 6 years, not realizing that what's happening to you, right? So, basically there's no high probability trade presenting itself, just the opposite of yesterday, and I'll come back to that in just a moment. I said I was going to talk about the most repeated pattern, and I just took the Kiwi chart, zoomed in on it, and created a little picture. I'm looking for it on my toolbar here. Oh, there it is. It doesn't matter what the pair is, but you'll notice I mentioned earlier in the call, buyer-seller advantage, 2, range big enough for good risk management. Okay, we need those 2 things. Now, if we've got a buyer advantage, for example, let's say that the buyers had an advantage here. We won't talk yet about the range being big enough, but let's just say these ranges were big enough to trade. What you'd be looking for is a pattern that we teach, which is push, pull back, second push. Now, this is the most repeated pattern in Forex trading. It's actually the most repeated pattern in the world, period, once you get to know it. But anytime that the price is moving in a particular direction with no correction, at some point in time, it's going to pause, pull back, and then it's going to push again. And then once you tune your eyes into this, you see it over and over and over again. Now, you do need to know where these waves starts, and I have a technique called New Wave Fibonacci drawing that teaches you how to do this. That way you know that it's a new wave that's moving and not just, something that's part of another wave that already moved. But the reason why this pattern is never going to let you down is because this is basically the pattern that causes people to run out and buy Nike tennis shoes or to share a song that they hear on the radio. It's just in our DNA. When we see the crowd going this way, we want to go that way, period. It's just human nature. Now, you can make up your mind that you're going to be different and you're not going to go the way of the crowd. That's fine, but still it doesn't change the basic human nature, and you just can't get away from it. Right? So what you want to tune your eye into here, and this price starts right here. It makes a move. It moves farther than it did before. It makes a move. It pulls back, and then it pushes again. Now, the price does not start a new wave up. Here's the top of the old wave. Price does not start till here, and then it takes off. It really never pulls back, and it stops right there. Now, at some point along this way, it's going to pull back, and then boom, another push up. And then here we have it again. Another wave starts, breaks this former high, pulls back, and then boom, second push. So that's since that pattern repeats with about 90 to 95% reliability, and as inexperienced traders that I'm teaching, you need to win more than 70% of the time, we just base our trading on that pattern. It'll never let you down. And it doesn't matter if the candle's big or long, or if it's pin bar, if it's bullish engulfing, bearish engulfing. It doesn't matter if it's a right shoulder or a left shoulder. None of that matters. All that matters is it's a clear price move. The advance is strong enough to get in, and the advance is strong enough to get in and get out with good risk management. That's something right here. All right, so good risk management, and again, you have to have the whole package. You can't just take a couple of things that I talk about on this call and go trade. You need the whole package, plus you need the execution skills, which are really the most difficult part. But usually we're going to want to see at least 20 pips or more in one direction before we're going to consider a trade. Now, your risk to reward ratio is also really crucial here, because your risk to reward ratio, if you aim for more money, your probability of winning goes down. If your stop gets too big, your probability of making money goes down. And so you just got to know what all the pieces are, and you got to put them all together. But anyway, I just wanted to bring this to your attention. Now that you have that, I want to show you what we did yesterday morning. We were sitting here on this session. It was funny. I think probably some of the traders were kind of kicking themselves after the call because only one took the trade. But we were all just sitting here pointing out a trade, and only one person took it, and they weren't even on the call. But anyway, I'm going to show you how that played out. All right, so yesterday we saw this very strong move right here. Let me just move this over. We saw this very strong move right here coming down. And one of the things that you've got to do is you got to know where the waves of movement are. I mean, if you're trading a trend, right, everybody's buying Nike shoes, right? So you want to go get a pair, you better make sure that everybody doesn't already have one and they're not on to something else, right? You know, maybe they're buying Reeboks now. So, yeah, somebody noticed it was Adrian that took that trade. Just saw a little pop-up note. Yeah, good job, Adrian. So what I was saying is that everything works the same way in life. So what we're trying to do is trade this trend. And if you just look at the 30-minute chart, you might not know that everybody already has a pair of Nikes, and now they're wearing some new cool Reeboks. A new trend is starting, right? And you're the last one. You're the last one with a pair of shoes. And now your friends are showing up with Reeboks, and there you are with the old news, right? It's kind of the same thing. And I don't like to use that example because none of us wants be thought of as followers. But trust me, it's something that we do really well. But the point I'm making is you cannot make a decision about whether this is a good trend to trade or not unless you zoom in. So think of this 30-minute chart or whatever the time frame is that's bigger as you're flying up at 30,000 feet. You're just too far away to see what they were actually doing. So you might think, if you're looking at this chart, let me zoom in a little bit more here. If you're looking at this chart, you might think, wow, that started right here and just kept on going. Maybe it did, maybe it didn't. We need to get closer. We need to get closer to that. And the only way we can get closer, and I don't trade 5-minute charts, people. I zoom in to see what behavior was happening, right? And let's get back over here to where that happened, right here. And if I were to take my fib, I see chop, 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 chop. Here's a wave. Did that wave correct on the way down? It did. It corrected all the way to 50%. So that wave's no good. Remember, we're trading real stuff here, not candle patterns. Okay, so starting here at about this point, did that price pull back? Nope. Nope. And so that ends up being the correct starting point for our fib right there. And it continues on down. So we showed up yesterday at this time in our live trading right here. And I said, oh, look, it's sitting right there. There's the 38.2 pullback. Now, there was high-impact economic data, market conditions, coming out at 10 a.m. Eastern. So it was coming out, I don't know. Well, you can see right here, it's about 6:40. Oh, we're a little bit later. We were here. Okay, but still, same thing. We won't trade anything unless it gets back into the 38.2 or higher area. Now, since there was high-impact data coming out, I had a sell entry limit order sitting right here at 50%. And the reason why I did that is because when you have high-impact data for the dollar coming out right near your trade, there's a couple of things you have to think about. The first thing is, are the traders and investors concerned about that information, right? Either they are or they aren't. If they are, get out of town. If they're concerned about what this information means, get out of town, because it has a much higher probability of being super, hyper volatile. That means it doesn't matter where you put your stop or entry. Your entry might get picked up. It might not if it moves fast. Your entry might get picked up, and your stop doesn't get hit and it goes 100 pips against you, your stop didn't get triggered because the broker couldn't get the price, and oh well, tough luck. That's what the fine print's for. Point is if traders are really watching that information, you don't want to be anywhere near it, because I think you got less than a 50% chance of winning just because your orders may not get executed. And so again, if investors and traders are focused on that information, get out of Dodge. Don't touch it. Get away from your computer. Learn how to recognize when you're at higher risk. And trust me, guys, if you had thousands of dollars in the trade, you would suddenly become acutely aware that this is not a good time to trade. But when you don't have anything really at risk, you have to learn that. So the second thing that we need to consider, or we could consider, is if investors and traders are not paying attention to that information, we've got increased risk, because high impact data is going to create some additional speculation. It's not likely to be hyper volatile, but it's likely to be a little bit more volatile, which means it's going to be probably a little bit more up and down price movement. So if you're looking for an ideal trade coming in here at a pullback of, say, 38.2, but high impact data is coming out in 15 minutes, you got a little bit more risk of price chopping around a little bit. But if the trend's been moving down with no second push, the high impact data is not likely to change it, but it still might bounce around for a while, because most of the investors and traders don't know what I'm telling you. But my first teacher told me there is no piece of information that is likely to change the trend. So that's something you can put in the bank. If the trend's exhausted, then the high impact data might just be the information the market needs to decide which way it's going to go. But if the trend's moving this way with no second push, no piece of information is likely to change that direction. But what it will do is it might change the price you get. And so that's why I had an order sitting here up at 50% instead of 38.2. I had to mitigate that risk. There's additional risk of more volatile price movement. There is additional risk. That if there's additional risk, you have to do something about it. Not in level 1, level 2, or level 3 of my program, but when you're trading more money, you'll need to do that. But it was all fair game at 38.2. Just sitting there, we're chatting, and there, boom, look at this. Right at 38.2, didn't move up enough. It was just pretty clear positive for the U.S. dollar, so down they went. And so if you were entered at 38.2, had a high probability target about right here, stop right there. Good job, Adrian. Adrian took that trade. So again, you have to be able to know that the sellers had a high probability advantage moving down in this trend. Then you have to know where the waves start and end. And then you have to know if the waves are big enough to enter and exit with good risk management, having a good risk to reward ratio, staying out of the range of noise. And then you just put it in. And then beyond that, you have to learn to execute. And on that note, I'll talk about that for just a moment. Execution is the hardest part of Forex trading. You guys are masters of probabilities, every single one of you. And the reason I know that is because you live every moment of your life and have been your entire life based on probabilities. And if you want to test that, if somebody put a gun to your head right now and said, tell me what's going to happen in the next 5 seconds, you would not be able to tell them. Nobody knows what's going to happen 5 seconds from now. So your entire life, you've become a master of probabilities. So the key is learning what the elements are that affects your probability of winning, and boom, you've got that. The hard part is learning to execute. And in ordinary life, we don't have any experience, or at least 99.9% of us, we don't have experience making high-risk decisions. We just don't have any experience at it. And so when we get into a high-risk situation, what we do have experience at is, looking at the situation, feeling pretty good about our conclusions, and, the logic all mixes well. But we're comfortable with our decision, buying a car. Yeah, I'm pretty comfortable, okay? Or, I don't know, whatever decision you're making. You get a level of comfort once you get a little older. say, well, I'm not going to buy unless I'm comfortable. Okay, you can't do that with Forex trading because, when you're new and you're learning high-risk decisions, just about everything you feel is going to be wrong. It's just going to be wrong. You're going to feel like getting in when it's not a good time to get in. You're going to feel like getting out when it's not a good time to get out. It's just, and that's just the way it is. And so since we don't have experience at making these high-risk decisions, it's not complicated. It's just you need to train yourself to do it, right? And so what we do is we teach all the parts that affect your probability of winning, and then we don't tell you what setup to trade. What we do is we give you all the logic. We show you where to put your hands on the baseball bat and where to stand, and we say swing, right? And we watch you, and we find out what you see and do well. Now, once you have that part down, which takes 4 to 6 weeks, we got to watch you. We got to find out what you do and make sure that you're covering all your bases when it comes to logic. Once you have that, then we don't write your trading plan. We ask you, why did you enter there? Why did you exit there? Why did you draw that Fibonacci there? I want to know in your words how you made that decision, because if I use my words, trust me, you will not be able to trade. So it's very important that this is something that you see, that you already know how to do, and then that you define for yourself. Now, if you get all of that right, then all you got to do is swing the bat. So most Forex traders, what are they doing? They're actually turned around backwards at the plate. They're using the wrong hand. They're swinging before the ball gets there. They're swinging after the ball, and they have no idea what they're doing, right? So you got to get all that right, and then once your hands are on the bat and you're facing it, and you know that you're supposed to keep your eye on the ball, and you know your knees are supposed to be bent a little bit, you're going to first work on that timing, right? Timing. And so the only way you can learn how to do anything like this is just practice. But you got to practice the right things. That's really key. And so you just practice over and over and over again. And trust me, when you take your setup that is consistent with good logic, you execute it well. Once you do those two things, you make money. And I'll tell you something else. There's nothing exciting about Forex trading. What's exciting is the possibility of what it can do for you. But once you can do it, trust me, there's nothing exciting about it. You're staring at a computer screen. You know how to do it. There's no mystery, right? And I'll tell you something else. A full-time trader only trades about 5 to 10 minutes a day, unless he's, wanting to, put floaters in his eyes and pop his retinas and mess up his back just staring at a chart all day long. Traders do not, some traders do. There are some exceptions, but by and large, a full-time trader is going to trade 5 to 10 minutes a day. Why? Well, when I showed up this morning, how long did it take me to look at this and assess whether there was any possibility of a high probability trade? Maybe 1 minute. I was able to assess very quickly, but it goes even farther than that. This is not my trade. My trade isn't even close to setting up right now. So I could just glance at it, boom, 2 seconds, out of the room, right? But if price starts to break above here or break above there, you could have an alert that calls your phone. Okay, maybe come look. No, nothing there. And so, trading is very much like hunting or fishing. You do everything right and then you wait, right? You get the right bait, the right hook, the right location. You do your research about the time of day, the weather. You get all that information and then you get in the right spot and you wait, right? Same thing with deer hunting. You don't run through the woods looking for a deer. You do everything right and then you sit and wait. This is the same thing. And so always remember that if something doesn't make sense, either one, you don't understand it, or two, there's something wrong with what you're being told, right? It all needs to make sense in order for it to work. Okay, so let me see if any of our traders had any questions. I just look at Adrian's comment. Wow, I did take that trade. Yes, you did. You see, he didn't even know it. But he didn't need to. The setup came, and that was his setup, and he took it. And, there's days we come where nothing, and then boom, yesterday, there's one, right? There's a deer, 4-pointer right there, And the mistake that most traders make, and it's understandable because we want to succeed, we want to get the show on the road and make this happen. But here's the simple mistake that most traders make. They're trading possibility, not probability. They're trading possibility, not probability. And you have to keep focused on what are people doing when they gamble at the casino. I'm talking about most people, not professional gamblers. Are they focused on possibility, what's possible, or what's probable? They're focused on what's possible. So you see, this is the dividing line, the two different mindsets. And yes, if we were focused on what's possible, I could actually probably snag some pips out of here with my experience, and you could probably too. And sometimes you'd win, sometimes you'd lose, but overall it wouldn't be a very high winning percentage. And when you lost 7 or 8 in a row, you'd feel like committing suicide, and it's just not a good game to play. But if you were focused on possibility, you'd be looking for a trade right now. You might even go to the Euro Yen or some of their crossbearer, and you're looking. You're going to find something, and when you look for something, you do find it. So really, the key is really knowing what affects your probability of winning, and knowing that the probabilities are not good for trading right now, and just being able to step back. All right, so let me see here. Members, you guys hang on for a second. I'm going to kind of wrap this part of the call up, and we'll visit for a couple minutes. If you're not currently a member, I promise you that this is the best Forex training program in the world. You'll see that right away. Most of what you see out there isn't even training. It's just education. Training, write this down. Training is us watching you, right? Watching you swing the bat. Education is you listening to the coach. And so if the trainer is not watching you like they do in boxing and the Olympics and pretty much everything else in life, if the trainer's not watching you, it's not training. If you're on a live trading room like right now, listening, if you're reading discussion forums, that's education. If you're watching videos, that's education. If you're watching DVDs, that's education. Until somebody's watching what you're doing, it's not training. And so that's why I'm pretty confident this is the best training in the world, because almost no one's training. But just to back that up, we'll back that up with a 30-day money-back guarantee. It's only $99 a month. People do ask me, why do you do this so inexpensive? Because I can. Because I can. That's why I do it. Anyway, I want to show you guys where. Just go to forexartofwar.com. I'm going to bring that over. Right here. It's right there, right on the top of the page. If you want to know more about the inside of the trading program, be sure to watch this video. The first part of it is a little bit of analysis. I think I put something up that shows you can skip to, I don't know, somewhere in the video. But if you want to see what we're doing, get an inside look at it, you can see that there, and also sign up there. But I guarantee you're going to love it. You're going to absolutely love the training. If you don't, then you just get a refund. So to our guests this morning, thank you for your time. I hope you got something of value out of the session. That's my main focus, is give you something that you can use. Do get involved with us, though. You'll be glad that you did. So, team, hang on just a minute. I'm going to close out the public side of this, and then we'll continue on here together. Thank you, everyone.